Hey guys, welcome to another edition of the Trade Genius podcast. Phil and Bob here as usual. Guys, you're not going to want to miss this one. We got the data that tells you that we are heading for the great financial crisis 2.0, just like we had in '08. So let's dive in.
Trade Genius.
Hey guys, I'm gonna tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, you showed me some pretty interesting data. Doesn't look good.
No, I mean, look, they did it to us again. You know, what's that song? Oop, they did it again, right? So what these guys do is they drive down the ratio of risk assets, and people fall for this every time. And retail never gets out. The smart money bails out. But when you drive an earnings yield, forward earnings yield on the S&P 500, and you match it against the 10-year, see, the 10-year should be the benchmark. That's like the risk-free rate, right? So, you bench everything on the 10-year yield. And so now we have a point now where the earnings yield for the stock market is now matching up to the 10-year yield. Basically, you're getting no risk premium for owning a riskier asset. Does that make sense, Phil?
Yeah, it does.
And so when that happens, things break and things happen. And this would happen in 2008. They drove this thing down to one, because they do everything they possibly can to keep the Ponzi going and to keep assuring you that there's no problem. And then you just get these blowouts. But this is going to be a little bit different this time too, Phil, because they had elevated earnings as well. So we may go into a situation where the earnings yields are going to fall, to a point where the yields are falling, meaning the earnings are falling at the same time prices are elevated, if that makes sense, and the 10-year yield is rising. This is like perfect storm 2.0. Instead of calling this the great financial crisis 2.0, this might be the greatest financial crisis, because they just wound this thing up to such a point now where everybody is leaning on the wrong side of the boat.
Yeah, and this move, right, it has been so disconnected that this actually does not surprise me now. But you're right, this means that it's a big risk off event building. And to tie into the yesterday's video, we talked about the dynamics of when treasuries get downgraded, it actually forces a de-risking of equities. And so I think this is it's compounding the issue. So I think, based on that seasonality, I don't see really where they're going to get the juice from for any more upside to this. Because remember too, right, the T-bill issuance was driving everything June and July, and that ended on August 2nd. There's no more collateral to put into the system. The Fed's rolling off their balance sheet at a clip of 20 to 50 billion per week. It just depends what the mood they're in. And then you have the reverse repo balances, which all eyes are going to be on that now, because if that starts to roll over, the market's going to come down with it.
Yeah, and look, here's the rule of thumb, guys. You want your stock market to be yielding at least 3 basis points higher than the 10-year yield. Okay, and this is forward earnings yield too. This is basically marked to fantasy, right? The estimates always come down as the year goes. So, and then, when I was buying companies, our quick rule of thumb was we looked at the 10-year and then we added 6 basis points for risk and to make sure that we're getting, risk adjusted cost of capital here. I know, hedge funds and some of these other guys go even higher rates, but, that's a good rule of thumb when you're looking to invest your own money into a private entity and you're trying trying to get cash out of it. You don't want to be having an earnings yield of the product at the same rate you get 10-year. Just like in real estate too, guys, you're basically an idiot for trying to get a cap rate the same rate as a 10-year, right? You're going to need, at least 6 basis points higher, right? You shouldn't be touching anything in real estate unless there's a cap rate of 11 or 12. And
Right.
Those are called unicorns right now. They just don't exist. And if they exist, it's not going to last long because there's something probably wrong with the model. It's an outlier. So what I'm
Right.
telling you and what we're telling you is that it got as good as it got. You're better off, sitting there looking for either hedging, shorting, dividend paying. Even dividend stocks are not yielding the 10-year, okay? And I own a slew of energy names that are underperforming. The dividend yields are underperforming the 10-year. So there's pressure everywhere, Phil. And I just thought people should know this and plan accordingly, i.e. get conservative, get the cash, get in those 90-day, T-bills, lighten up on your position because you're going to look at these, when these yields blow out and they blow out fast,
Right.
you're going to have an opportunity 20, 30, 40% lower here in the next 18 to 24 months.
Yeah, and I think this is similar to like an inverted yield curve to a degree because it warns you that you're basically entering a recessionary environment. Not that this reading here means recession right now. It tells you it's coming. When you see the bounce, and that's usually what happens, right, is Fed starts cutting into a recession, and that's why you start getting the reflexive move. But what's good about this chart too, though, is it's not all bearish because when you do get to that extreme blowout side of 6 or maybe even 7 on the spread there, then you know that essentially the move historically would be over and you're looking for a bottom in the bear market on a weekly basis. And that's where your biggest returns are going to be. So I think it's a great guide. I think timing is probably the trickiest part of this, but I think if you give yourself enough time with hedging, whether it be leaps or whatever, this move is going to play out over months and months and months and months. So you're going to have time for this to not only start to manifest, but then write it down. It's not going to be like a 1 month blip, like say the pullback we might see here in August into September, and that might bounce. No, this is going to be where we start seeing this roll over in somewhere into Q4, and then we see and we'll watch the yield curve. The yield curve starts to go up. That 310 yield curve, which we're going to get into in the next video, starts to get over that par value of 0 and starts cranking back up and normalizing. I think we have the recipe for like multi-week, like 100-week, a lot of times that window opens up and you ride that all the way down and then get long. If you just did one of those moves at once in your life in your portfolio, you'll always outperform the market for the lifetime of your portfolio. It's that powerful. You do not want to miss this move.
Before I let you guys go, I want to shout out to Daily Shot here. Follow them on X. We get a lot of really good information there. It's a great place for you to learn too. And they actually pulled this data from that Charting Prodigy. Don't know anything about them, but their chart looked awesome. Shout out to them for letting us, use their source material. And with that, Phil, I'm good for today and catch you guys later.
See ya.
Trade